Hello everyone, welcome back to chapter 2 Money and Banking. In our previous lesson, we studied Reserve Bank of India and its important functions. Today, we are going to study one of the powerful tools used by RBI, that is monetary policy. Let me begin with a simple question. Imagine that the price of vegetables, petrol, school fees, and almost everything around you suddenly starts increasing. Or imagine the opposite. Business stops expanding, companies hire fewer people, and economic activity slows down. Who helps manage these solutions? The answer is the Reserve Bank of India. But how does RBI influence borrowing, lending, and spending across the economy? It does this through monetary policy. Think of RBI as the driver of a car. If the car is moving too fast, the driver applies the brake. If the car is moving too slow, the driver presses the accelerator. Similarly, if the economy is overheating with too much inflation, the RBI tries to slow it down. If the economy is weak and needs support, the RBI tries to encourage borrowings and spending. The set of actions taken by RBI to manage monetary supply, credit, and interest rate is called monetary policy. So in today's lesson, we will understand what monetary policy is, why is it needed, and the important tools used by RBI, such as repo rate, reverse repo rate, bank rate, CRR, and SLR. Don't worry if these terms sound confusing right now. By the end of the lesson, you will be able to explain each one confidently with example. Now let's understand the meaning of monetary policy. The term may sound difficult, but the idea is actually very simple. Think about your daily life. Suppose you have 2000 rupees as pocket money for the month. If you spend all 2000 rupees in the first week, what will happen? You'll probably struggle for the rest of the month. But if you spend wisely and plan your expenses, you will have enough money throughout the month. In the same way, an entire country economy also needs proper management of money. If there is too much money in the economy, people spend more, demand increases, and prices may rise rapidly. This can lead to inflation. If there is too little money, people spend less. Businesses may reduce production and economic growth can slow down. So who maintains this balance? The Reserve Bank of India. The RBI does it through monetary policy. So monetary policy is the policy through which RBI controls the money supply, credit, and interest rate in the economy to maintain stability. Now let's understand its objective. First objective is control inflation. If prices are rising too quickly, the RBI may take steps to reduce excessive borrowing and spending. The aim is to prevent inflation from becoming too high. Second one is promote economic growth. During period of slow economic activity, RBI may encourage banks to lend more. More loans can support businesses, investment, and production. Objective 3. Ensure price stability. The RBI tries to avoid extreme fluctuations in prices. Stable prices help both consumers and businesses plan better. Objective 4. Maintain adequate liquidity. Liquidity means availability of money in the economy. There should be enough money for people and businesses to carry out their transactions, but not so much it creates an excessive inflation. Objective 5. Encourage employment and investment. When businesses can access credit at reasonable rate, they are more likely to invest, expand, and create jobs. So the RBI aims to balance inflation, growth, liquidity, and employment, not just focus on one objective. So in the exam, don't just write the word definition of monetary policy. Also mention at least 2 objectives of monetary policy to make your answer stronger. So to remember the objective of monetary policy, you can use this trick. Good people love ice cream every day. So G, growth, P, price stability, L, liquid, I, inflation control, E, employment. Now let's understand the 2 types of monetary policy. This is one of the most frequently asked questions in CBSE and CUET. Let's begin with expansionary monetary policy. Imagine the economy is slowing down. Businesses are not investing. People are buying fewer goods. Factories reduce production. Unemployment start increasing. In such situation, RBI wants people and businesses to borrow more and spend more. How can it encourage borrowing? By making loans cheaper, by increasing money supply, by lowering the interest rates. So when borrowings become cheaper, the businesses are more likely to expand and consumers may be willing to buy homes, vehicles, or other goods. This approach is called expansionary monetary policy because we are expanding the demand of the money, because it aims to increase the supply of money and credit in the economy. Now let's look at the opposite situation. You think on your own. Imagine inflation is high, prices of food, fuel, daily necessities are rising rapidly. People continue borrowing and spend heavily. Now the RBI wants to reduce excessive borrowing and slow down the growth of money and credit. What should it do? It should decrease the money supply. It should increase the interest rate. It means it should not encourage borrowing and investment, rather it should make borrowing more expensive. So when loan become costlier, people borrow less, spending moderates and inflationary pressure may reduce over time. This is called as contractionary monetary policy. So let's compare them. Expansionary is used when economy needs support. Contractionary is used when inflation needs to be controlled. So think of it like a driving car. If the car is moving too slow, you press the accelerator. That's called expansionary policy. If the car is moving too fast, you apply the brakes. That's called contractionary policy. So this simple analogy can help you remember difference forever. So in your long answer question, always compare both policies in a table. It improves presentation and helps you score better. Let's start with the most famous monetary policy tool, Repo Rate. First, let me ask you a question. Suppose our SBI suddenly needs extra money. Where do you think it can borrow from? One option is Reserve Bank of India. When the RBI gives a short-term loan to commercial bank against approved security, it charges interest. The rate of interest is called Repo Rate. Now let's understand why it matters. Imagine RBI reduces Repo Rate. Since commercial bank can now borrow more money from RBI at a lower cost, it becomes cheaper for them to obtain funds. So bank may then offer loans to customers at relatively lower interest rates. When loan becomes cheaper, family use it for buying homes or cars. Students may take education loans. Businesses may invest in new factories and machines. So as borrowings and investment increase, economic activity also increases. This is why reducing repo rate is generally associated with expansionary monetary policy. Now think about the opposite situation. If RBI increases the repo rate, borrowings become expensive for commercial banks. Bank may increase lending for customers. As a result, borrowing may reduce, spending may slow, and inflationary pressure may ease. So remember, lower repo rate, more borrowing. Higher repo rate, less borrowing. So in the definition, always include the word RBI lends money to commercial bank and against approved security. Now let's study the opposite concept, reverse repo rate. This is where many students get confused. Let's make it very simple. Earlier we learned that repo rate, the RBI lends money to commercial bank. Now imagine commercial bank have extra fund that they don't want to lend immediately. So they can keep those funds with RBI for a short period. The RBI pays interest on those deposits. The rate of interest is called as reverse repo rate. Suppose the RBI increases the reverse repo rate. Commercial bank earn a better return by parking more money with the RBI. As a result, they may have less money available to lend to customers. This may reduce the supply of money and credit in the economy. So, higher reverse repo rate, bank keep more money with RBI, less lending. If the reverse repo rate decreases, bank may find it less attractive to keep the money with RBI and may lend more instead. Think of it this way. Imagine your parents offer you two choices. Keep your savings in a safe place and earn a good return, or spend the money. If the return becomes attractive, you are more likely to save. Similarly, commercial bank may choose to keep more money with RBI when reverse repo rate is higher. So the examiner often checks whether you understand the direction of money. So in reverse repo, commercial bank gives money to RBI. Now let's compare two concepts together. This is one of the most important comparison for the board exam. In repo rate, the RBI is the lender. Money moves from RBI to commercial bank. In reverse repo rate, the RBI is the borrower. Money moves from commercial bank to RBI. Think of two arrows. One arrow go from RBI to bank, the other one go from bank to RBI. This is the easiest way to remember the difference. If you remember the direction of money, you will never get confused between these two terms again. So in comparison question, draw arrows showing direction of money. A simple diagram often makes your answer clearer. Now let's move to another important rate, the bank rate. Many students ask, isn't bank rate the same as repo rate? The answer is no. Although both involve RBI lending money to commercial bank, the main difference is in the case of repo rate, the loan is generally short term and involves approved security. In case of bank rate, the RBI lends money without a repurchase agreement and it is generally associated with long term lending. So when the bank rate increases, borrowing from RBI becomes expensive for commercial bank. So bank may then increase lending rate for customers. As borrowing decreases, spending and investment may also slow down, which can reduce inflationary pressure. Similarly, if bank rate decreases, borrowings can become cheaper and economic activity may receive support. So for CBSE, the most important point is to remember basic definition and understand that both repo rate and bank rate influence the cost of borrowings for banks. So don't write that repo rate and bank rates are exactly same. Mention at least one difference in long answer questions. Now let's study one of the most frequently asked topics in CBSE board exams, cash reserve ratio or CRR. At first this sounds like difficult term, but it is actually very logical. Imagine you own a shop. Every day customer buy products from you. Would you spend every rupee you earn immediately? Of course not. You would keep some money aside for emergency. Bank also follow a similar principle. Whenever bank receives deposit from customer, they cannot lend all the money. A certain percentage may be kept as cash with Reserve Bank of India. This percentage is called as cash reserve ratio or CRR. Let's understand with a simple example. Suppose a bank receives deposit of 100 crores. If the CRR is 4%, the bank must keep 4 crore as cash with the RBI. The remaining 96 crore can be used for lending and other banking operations. Now imagine RBI increases the CRR from 4% to 6%. The bank has to keep 6 crore with the RBI instead of 4 crore. This leaves less money available for loans. As lending decreases, credit creation also decreases. This can help reduce inflationary pressure. On the other hand, if RBI reduces CRR, bank can lend more, increase money supply and support economic activity. So remember one important keyword. CRR is cash with RBI and it is not bank's own vault. Let's now understand statutory liquidity ratio or SLR. Many students confuse CRR and SLR, but after today's lesson you will never mix them up, I believe. Just like CRR, SLR is also a percentage of bank's deposit. However, there is a major difference. Under SLR, banks do not keep the entire amount with RBI. Instead, they maintain it in the form of liquid assets. These liquid assets include cash, gold, approved government securities. Let's take a simple example. Suppose a bank has a deposit of 100 crore. And if SLR is 18%, the bank must maintain 18 crore in the form of eligible liquid assets. Because more money is tied up in these assets, less money remain available for lending. As lending decreases, money supply and credit creation also decreases. Now compare it with CRR. In CRR, the reserve is maintained as cash with the RBI. In SLR, the reserve is maintained by the bank itself in the form of cash, gold or approved government securities. So the single difference is the key to the entire topic. So whenever you define SLR, mention the word cash, gold and government securities. These keywords are very important for scoring full marks. Now let's compare CRR and SLR. This comparison is asked regularly in school exam. Both are tools used by RBI. Both influence the amount of money banks can lend, but they are not the same. The first difference is the type of reserve. CRR is maintained only as cash. SLR is maintained in the form of cash, gold, approved government securities. Second difference is where the reserve is maintained. CRR is kept with RBI. SLR is maintained with commercial bank itself. The third point is both reduce the amount of money available for lending when increased. So here's a quick way to remember. If the money goes to RBI, think it as CRR. If the bank keeps the liquid assets with itself, it is SLR. So a comparison table is the best way to answer this type of question in board examination. So before the exam, revise these 5 tools together instead of separately. Students usually lose marks because they confuse the direction of money or where reserves are maintained. Always draw a flow chart or comparison table wherever possible, whenever possible. This makes your answer easier for examiner to read. Remember, understanding is much more valuable than memorizing. So repo, RBI gives money. Reverse repo, banks return money. CRR, cash with RBI. SLR, safe liquid assets with bank. Bank rate, RBI lends generally long term. So here's a challenging question for you. If the RBI wants to reduce inflation, which monetary policy tool it may use? Explain your answer. Write your answer in the comment. Finally, we have finished. And if you found this lesson helpful, like the video, share it with your classmates and subscribe to the channel. In the next lesson, we will complete the chapter by studying open market operations, moral suasion, margin requirements, and we will revise all the monetary policies together for the board examination. See you in the next class. Till then, keep studying. Bye bye.